How did Dave's Hot Chicken reach a $1 billion valuation in just 8 years? Welcome to the Week in Restaurants. I'm Jonathan Mays, editor-in-chief of Restaurant Business, and I am here with executive editor Lisa Jennings. The big news this week came courtesy of Roark Capital and Dave's Hot Chicken, so we talk about that, both from Dave's perspective and the perspective of the private equity firm. And speaking of chicken, McDonald's is bringing back the snack wrap, so we will chat about that. And later on, tech editor Joe Guszkowski talks about AI agents. Lisa, would you use AI to choose your meals?
No, I wouldn't, but I can see how it would benefit you in terms of searching for recipes.
Yeah. You can see how it would benefit for searching for recipes. But first, let's chat about this Dave's Hot Chicken deal. Tell us about it.
Yeah, so we knew this was coming and had been previously reported, but Dave's Hot Chicken, which is based in Pasadena, actually, and Nashville Hot Chicken fast casual concept has been acquired. A majority stake has been taken by Roark Capital, which is, as I keep calling it, a restaurant deep portfolio of brands that includes Subway, which they bought a couple of years ago for quite a lot of money, as well as the multi-brand operations Go-To Foods and Inspire Brands. And then they have a bunch of other ones, Nick and Jim's Barbecue and Culver's and Nothing But Cakes. I mean, they do mostly franchise brands. They saw Dave's Hot Chicken as an opportunity. There's for growth. I mean, it's 250 units, or no, I'm sorry, 315 units domestically. They're in Canada, the US, the UK, and the Middle East, and they see a big opportunity to grow overseas. And Roark happens to know quite a few franchise operators. And so I think this could be a good match for Dave's Hot Chicken if they want to grow internationally. They also want to move into non-traditional. And I think that's a really good idea. I mean, college campuses, it seems like this brand would do really well there. So this, this is in 8 years, they've gone from scraping together $900 to fry on portable fryers in an East Los Angeles parking lot to, these three guys having a company worth $1 billion, which is pretty amazing. This is all with the help of Bill Phelps, who is somebody who knows how to scale brands. He was behind Wetzel's Pretzels. He was behind Blaze Pizza. And they have a group of investors that are, include quite a few celebrities and high-end people who I think are very good from a marketing standpoint. So off we go. We'll see what happens. I mean, the haters out there are saying private equity will ruin Dave's Hot Chicken. I don't think that'll happen, but what do you think, Jonathan? What do you know about Roark?
Well, Roark right now has sort of a mixed history. Let's be honest. I mean, but they're not stupid. Roark isn't stupid. And, the best comparison I can give it would probably be Culver's. Even though really Culver's, they're only a major investor in Culver's. And I think it's like 50% or something along those lines. And the Culver family is still involved. And but Culver's grew almost 16% last year. They've one of the most consistent, stronger growth stories that we have in the fast food space, particularly, just kind of continuing to do what it does every single year. And Nothing But Cakes, by the way, is also, generally really strong. 17% total growth last year. Kind of an underappreciated concept, if you ask me. If they're smart, and they are, they're not dumb, they'll kind of let it just be itself and essentially just let it continue to grow like that and not really mess with it. The worst thing that they could do would be to drive more aggressive growth than they should, force bad leases or things of that nature. They really want Dave's to Dave's grows well on its own. And they just really, you don't want to mess with it unless it just absolutely needs messing with. And I do have some things to talk about Roark, but I wanted to point this out and I want your thoughts on it real quick. They're kind of the quintessential, in some respects, a quintessential modern brand. Because they started in 2017 and to get to $1 billion valuation. And they did that with number one, chicken, right? chicken is very popular, 24% total sales growth, fast casual chicken last year, which is insane. Spicy, U.S. consumers like spicier food these days. The kids love the spice, which as parents, we both know, both my children just throw hot sauce on their breakfast cereal in the morning. And, and then third, they used social media very aggressively from the get-go, just really saw an opportunity. And to me, that's kind of it. That's what's fueled as much of their success as anything else.
For sure. Yeah. I mean, like Drake is one of their investors and that was huge for the brand. And he gives away free chicken on his birthday. And, Usher, also in the music world is actually a franchisee of the brand, with a partner. And, so you've got that kind of going for them. They really know how to use social media to drum up interest in the brand, for sure. It's fun. It's exciting. And but to your point about what makes it current, if you look at the chicken players that are out there right now, they have a simple menu, and Dave's has a very simple menu. It's chicken tenders, sandwiches. Now they have little sliders, which are just smaller versions of the same thing. Milkshakes, drinks, fries. That's it. They at cauliflower. Now they have the not Dave's chicken, which is the cauliflower, and that was a big deal for them. So they're keeping it simple. Fundamentally, what's working is that franchisees are making money off the brand. They've got a great return on investment. It's very similar to Wingstop, which is something that Jim Biddix, the president of Dave's, pointed out. They would love to see Roark follow that model. Roark owned Wingstop, spun it off with an IPO in 2015, I think it was, and that brand has continued to grow and over the past couple of years has had eye-popping results. I mean, the industry's been watching Wingstop and been amazed at what they've been able to do, and they did it largely from moving into boneless chicken tenders, for example, is something they've just started doing, and this is what people want. And if you find operators that can do it well and to get great return on what they're investing in, these are the brands that are going to succeed. Some of Roark's brands are not doing quite as well, but I think they're seeing Dave's as one that really has a lot of opportunity. And as long as people are getting their return on that investment, it's going to keep growing.
Let me talk really fast about some of Roark's concepts. So this now gives them, they have now 21 brands, 21 restaurant chains. As you mentioned, you got the two, multi-platform companies. They got Subway that they bought. They completed last year. And then, all sorts of brands. They have two of the top 10 restaurant chains in Dunkin' and Subway. They have 5 of the top 30 as you add Sonic, Arby's, and Buffalo Wild Wings. And then I think all of their brands are in the top 100 restaurant chains, which is pretty incredible. So 21 brands, Lisa, $53.2 billion in U.S. system sales. And McDonald's $53.5 billion, which says as much about McDonald's as it does anything else. But, that's pretty sizable. However, had they, I did some calculations. Actually, it's not 53.2, it's $52.2 billion. I did some calculations because their median sale, their total sales growth last year of all their brands was just 1.1%. More than half of their brands actually lost sales last year. That includes Arby's. Their sales down 6.5%.
Of course, that was pre-Dave's. So, right.
Right.
Last
year.
So,
yeah. Arby's sales down 6.3%. Sorry. That's pre-Dave's. To me, it's a fascinating situation over there at Roark. 12 of their 20 brands last year, not counting Dave's, reported a sales decline. You did have a few brands such as Nothing But Cakes, Miller's Ale House, which is doing really well. Culver's, as we mentioned, Jim and Nick's Barbecue. They're casual dining brands. All of them are growing, actually, oddly enough.
Yeah.
They should probably buy more casual dining chains. They only got 3. But a lot of their brands are really struggling right now. And a lot of it, you got Hardee's and Carl's that are struggling quite a bit. Carvel has had a really tough year, down 6.5%. We got Sonic, which has really struggled for the past couple of years. Subway's, I don't, you don't blame Roark for that. Roark got into it. Roark knew what they were getting into with Subway. But I mean, they've got some issues that they've got to fix. And I think that, Dave's gives them some growth. But they're, they would have, if they had just kept pace with average restaurant sales, they would have had another $1.6 billion in total sales last year. So, it would have been, it was sort of, it was a tough year, I think, for Roark. And this is a good purchase for them.
Yeah. Yeah. And it'll be interesting to see how it impacts Dave's, for sure.
Yeah, we'll see.
Yeah. Well, so since we're talking about chicken, now you got McDonald's doing the snack wrap. You did say this was coming. We all thought they were going to do this. What's it going to mean?
Well, that's a good question, isn't it, Lisa? So the fascinating part, you remember when they got rid of the snack wrap the first time, which is in 2016. You remember the context at the time.
Please remind us.
Well, the 2016 was when that's the year they expanded. They had just added all-day breakfast. And we were really concerned at a time about McDonald's operations. That's a fair concern, by the way, with all-day breakfast. It was difficult to operate. And they needed sales lift. They needed a sales lift at the time. And so they turned to all-day breakfast. And then snack wraps were a casualty of that because they needed to make way. There were some concerns about the operations and things like that. So they got rid of the chicken selects and then they got rid of the snack wrap. And then, all day breakfast helped turn around McDonald's sales, and then they got some momentum, and then, I think 9 straight years outside of the pandemic, 9 straight years of same store sales growth, which is really, really good. And now their sales are problematic again. And now they're bringing back the snack wrap. So they just added the McCrispy strips and now they're going to next month, they're going to bring the snack wrap back, basically using the McCrispy strips as a foundation piece for the snack wrap. And they did it because people have been clamoring really for the past couple of years. And I think restaurant chains have seen that there's some potential in bringing back menu items like Taco Bell did with the Mexican pizza and stuff like that, where, consumers clamor over and over for the return of this product. And I mean, I guess we'll see, but I know franchisees are pretty bullish about the potential for it. They've been pushing for this now for really the past couple of years. But it's just an interesting phenomenon that in 2016 that they felt that they could get rid of it when their sales were problematic. And now their sales are problematic. So they're turning to a product that they got rid of, 9 years earlier. And so market is just much different. I mean, Dave's Hot Chicken did a $1 billion, got $1 billion valuation. And since, actually, that's funny, Lisa, since in between snack wraps, Dave's Hot Chicken was formed, started, grew, went through a pandemic, generated a $1 billion valuation, and was sold between snack wraps.
Right. Well, I mean, I have to point out that, at least from my taste, the McDonald's chicken tender is nothing like Dave's Hot Chicken tender. Not comparable. But I would say I remember trying the snack wrap back when it came out the first time. And I remember saying, hey, this is something that I would absolutely go to McDonald's to get, because it was, not a giant burger. It was something that somebody like me who tries to eat healthfully could choose. And I liked it. I thought it was great. And, now that we have GLP drugs, we have these people who are looking for sort of lighter, snackier things that are smaller. I mean, it kind of would fit perfectly with that audience. I'm not sure they're going to McDonald's. They probably are, but
everybody goes to McDonald's, Lisa.
Yeah. Okay.
Nearly everybody in the United States goes.
So, I mean, to me, it makes perfect sense. I feel like it will do well, but we'll see. We'll see. Maybe, we've seen things that McDonald's has introduced in the past that I thought would be great. Other people disagreed, apparently.
Yeah. Well, I mean, if they bring things back, you've got to expect that it'll do pretty well early on.
I think
You know, the
people will
question
definitely
is,
go try it. Yeah.
I mean, people will go and try it. I will.
Yeah, for sure.
I will. I'm probably legally obliged to actually try it. But like, you know, I'm you know, so you got to imagine it's going to do pretty well for a couple quarters. That will lift them out of their sales. You know, they've had a sales slump pretty bad for them.
Yeah.
And then they'll, but it's really what happens 2 quarters down the line.
Have they said how they're going to price it yet?
No, I haven't seen it.
Yeah.
You know, and that's
That'll be interesting.
So really good. All right. Superb. Later on, we got Joe Guszkowski talking about AI agents. But first, whatever Ad Spoons throws up next.
Keep up with what's happening in the restaurant industry with Restaurant Daily.
I'm NRN Managing Editor Leanne Zinsmeister.
I'm RB Managing Editor Heather Lally.
We bring you a specific look of what's happening in the restaurant world from brands like McDonald's, single unit mom and pop shops, and hot button issues like inflation, tariffs, and more.
Start your day right with the Restaurant Daily podcast every weekday on Apple Podcasts, Spotify, YouTube, or wherever you get your podcasts.
And be sure to subscribe to never miss an episode.
Hello and welcome to Tech Check, where I, Joe Guszkowski, talk really fast about one big topic in restaurant tech. This week, how AI agents might change how we order. What if AI knew you so well it could order your lunch for you? That may sound crazy, but it might not be as far off as we think. Earlier this year, OpenAI launched a tool that can make reservations and order food from delivery apps. More recently, both Visa and MasterCard unveiled AI agents that can learn your spending habits and make purchases on your behalf. It's probably only a matter of time before AI agents are choosing what we eat. And this would obviously have major implications for restaurants. If consumers start placing orders through AI agents, we may no longer need things like search engines and mobile apps. And if you ask the AI to pick a place for dinner, it might choose something completely different than you would have on your own. So restaurants may have to learn how to appeal to those AI agents rather than Google's algorithms. It's still too early to say for sure how this all plays out, but it's looking like AI agents may be the next chapter of online commerce, just as restaurants were starting to get comfortable with the current one.
And that should do it for the Week in Restaurants, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at restaurantbusinessonline.com. But by all means, subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, the editor-in-chief of Restaurant Business, for executive editor Lisa Jennings. Thank you for listening.